Welcome to Real Estate for Beginners. I'm Gershon Levy. In this episode, we're going to talk about that actual offer process and then cover some general information of what goes inside of those offers. Now, please keep in mind, I'm based in Las Vegas, Nevada. So the information I give you about offers is based on Nevada. It could vary a little bit by state. So now let's talk about the actual offer process when somebody wants to purchase a home. So let's say I'm a buyer and I found my dream home. I want to purchase it. I go to my buyer's agent and we discuss the proposed terms that I want to send to the seller. Once we've come up with the terms that I as the buyer feel comfortable with, my buyer's agent will write up all those terms in the form of an offer, right? And then send that offer over to the other side to consider. Right? I'll sign the offer and then they'll send it over. But the offer is not the only thing that the buyer's agent is sending to the listing agent and seller to consider. We also want to send over how the buyer intends to pay for the property because we want the sellers to take us seriously from the beginning. So the two ways you do that, the two forms you can send to do that are either a loan pre-approval, which is a letter from a lender showing you've been financially vetted for a loan. Or if you don't need a loan, right, and you have the cash in an account, you'll instead set a POF, or a proof of fund sheet, which can be something like a bank statement from your bank showing you have the money in an account. Either way, the offer gets sent with the financials to show the seller that we are serious. Now, once the seller reviews all this stuff, they might be like, hey, this is perfect. These are all the terms we wanted. And if the seller feels good, they will sign the offer, right? No negotiation, no counters needed, and we have a purchase agreement. But most deals, most cases, are going to have at least one or two proposed changes from the seller back to the buyer. And what we call those is the counteroffer. The counteroffer is basically a piece of paper saying, hey, I, the seller, agree to all the points you proposed as a buyer. The only things I want to change are A or A and B. Now we'll go back to the buyer, and the buyer can either accept, decline, or they could send a counteroffer back over to the seller, right? Maybe the seller wants $10,000 more, but the buyer only wants to pay $5,000 more. The buyer can then send that back and say, hey, I'm cool with everything you just said, but I only want to pay $5,000 more. Either way, you can go back and forth, but once the buyer and the seller come to an agreement after the counteroffers, they sign them, and we have an official purchase agreement or contract. And this contract, right, will dictate the terms of the sale of the home. Now, how do we change the terms of a contract once it's already signed? Well, that's easy. It's called an addendum. I'm going to write that down right under here because it's an important term for you guys to know. Addendum. An addendum is a form that your agents will essentially fill out for you that are signed by the buyer and the seller, and they will be attached to the end of the purchase agreement and become a binding portion of it. So if there's something that was agreed upon in the purchase agreement that needs to be changed, all you do is fill out the addendum, and now we have a new contract and everything's fine. So we know how we got from interest to offer to contract, and we know how to change those contracts. Let's talk about what's actually inside of that initial offer. What are the terms that the buyer and the seller are actually negotiating over? So what's in an offer? Well, we just discussed the offer process going from an offer to a contract, and now let's talk about what the buyer and seller are actually negotiating about in the offer. So up here, I have 8 different points I want to cover. I know there's some more that I probably haven't listed, but it's real estate for beginners, and I don't want to overload you guys. So number 1, we have price. What price is the buyer offering to the seller? Pretty self-explanatory. Number 2, we have the EMD, which is the Earnest Money Deposit. And I'm going to write that down and say it again because it's very important. Earnest Money Deposit. I hope this is big enough for you guys to see. So the EMD is a very important part of the offer and of the contract process. So in residential real estate, the buyer is expected to put down some sort of a deposit at the beginning of the contract period, right after they sign the paperwork, maybe a few days into the contract period. Now, what's commonly accepted or what's commonly practiced, I should say, is that the EMD or the deposit would be about 1 to 2% of the total value of the contract. So if the buyer is buying the house at $500,000, you can expect the EMD to be around $5,000 to $10,000. Now, one thing you should know is that there's no rule about how much or how little the EMD can be. The sellers will request a specific amount in the listing and the buyer can abide by it or not. And they usually do to get on the seller's good side, but EMD can be my watch, it can be this pen, it can be anything of value. But what's commonly practiced is that it's money. Now, a common question is who holds that deposit? Well, in the offer, there's a place to check who will hold it. Either the seller or the most common practice is going to be the third party, the title company. The title company generally will hold the deposit for the duration of the contract. Now, there's a couple really important things about this deposit. Number 1, it represents the total sum of the risk for the buyer in this deal, meaning that if things go crazy and at the last minute the buyer has to pull out and cancel the contract, the seller can't go after the buyer for the full value of the house and say, hey, you have to buy my house. That's crazy, right? So this deposit represents the full amount of money that the buyer could probably lose in this deal to the seller, right? It's the seller's recourse to go after. Now, there's a lot of things built into the contract to ensure that the money's protected, to make sure that deadlines are being met, things are being done by the buyer and the seller. And a lot of the contract is built around making sure it's protected, and we're going to get into how it's protected when we talk about contingency periods. So number 3 is going to be financing. Financing in an offer, you're going to put down if you need it or not. If you don't need financing, you won't put anything down for the loan. You'll just put down that you're going to do a cash offer. But if you are getting a loan, you're going to put down the specific loan type, and you're going to put down the amount of money that you're going to get from the lender. Number 4, we have down payment. So remember, no lender is going to give you 100% financing for a deal. So if you're buying a home for $500,000, right, they might lend you up to 95% of the house's value, let's say. You would have to come up with the remaining 5%, which in that case would be about $25,000. Now, one thing to know is that the down payment is not separate from the EMD, or I should say that the deposit is not separate from the down payment. So if your lender says, hey, you got to put down $25,000 and you're already putting down $5,000 as a deposit, then the remaining amount of down payment you put at the end is going to be just $20,000. Number 5, every offer should have a closing date listed that the buyer suggests. Basically the day in which, the final day of the contract where all the paperwork's signed, and the buyer will get the keys, the seller will get their money, and the deal will be finished, right? And again, these are things, all these things you can go back and forth negotiating between the buyer and the seller, but closing date is a very important part of an offer and contract. Number 6, title company and escrow officer. I know we haven't talked a lot about title and escrow, the word, yet, but that's because I'm saving it for in a few minutes to explain it really, really well, since there's a lot of different terms associated with it. But essentially for right now, a title company, you should know, is a third-party intermediary that's involved in the deal between the buyer and the seller. They work for both the buyer and the seller, and they have a lot of really important jobs. They insure the deal. They're going to hold the deposit in most deals. They're going to make sure that the seller's not selling the house to multiple people at one time, or there's no problems with the ownership of the home. And then at the title company, they have what's called an escrow officer that's going to manage the deal for the buyer and the seller. Each title company will have a couple, and in the offer, the buyer will say, hey, I want to work with, let's say, ABC Title Company, and at that title company, I'd like to work with Ann Rice, let's say. So the buyer suggested the seller can counter if they want somebody else, but generally, if the buyer insists on a specific title company, that's who you're going to use. Number 7, we have who pays what. So essentially the fees, right? The other fees included in the deal. And these fees can really, really creep up on you in an offer. So you got to pay attention to how much of these fees you're paying and who is paying these fees, either the buyer or the seller. A lot of fees are just split down the middle, right? A lot of times in a normal deal, it'll say that, hey, I'm not going to pay for your closing costs and you won't pay for my closing costs. But sometimes in different markets, certain sides will pay for the other's closing costs as a way to entice them into the deal. And closing costs are essentially just costs associated with making the deal happen. A lot of times, specifically fees from the title company. Other types of fees that you have to discuss who's going to pay for them are HOA fees. A lot of HOAs charge fees about moving in and out of an HOA. And then taxes from the county, taxes from the state, right? There's places that you can say which side is going to pay for that. One common example is a transfer tax. Generally, sellers pay for a transfer tax, but a lot of times buyers might offer to pay that if they're trying to, again, entice the seller to agree to a deal with them. And then finally, we have number 8, which is contingency periods, which is, in my opinion, the most important thing up here. So we're going to have the next scene is going to be specifically about this, but just as a general definition, what contingency periods are, the easiest way to explain it. So the buyer puts down a deposit, right? What happens if the buyer cancels the contract for an accepted reason? Maybe the inspection came back and there was crazy stuff and they don't want to move forward. Maybe they couldn't get the loan from the lender. Maybe the appraisal didn't come back high enough. Whatever it might be, the contingency periods are clauses that are built into the contract by the buyer, right, to ensure that if the buyer needs to cancel the contract for an accepted reason, they can pull their deposit out of the deal with no problems whatsoever. But on the flip side, if the buyer doesn't abide by some of the rules that these contingency periods and clauses have set, they could potentially lose that deposit to the seller. So these are so important because it really dictates how this deposit is kept. The series is not quite over yet, so make sure you watch the next video, and please don't forget to subscribe to my channel. Have a great day, and thanks so much.